Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. America's top AI chip makers get the green light to sell in China again. I'm going to get you up to speed on everything you need to know from tech to trade. There's just an hour to go until the closing bell, and it's been a mixed day for markets as investors watch big bank earnings, inflation concerns, and that big news in the chip sector. We have a lot of news to get to, but first let's welcome in here Callie Cox, Chief Market Strategist at Whitholtz Wealth Management, Tech Editor Dan Howley, and our Markets and Data Editor Jared Blickery, who are all joining us throughout the show to break down the headlines. Jared, kick us off on the action markets are seeing in today's trade.
All right, we got a mixed board today. We can see the Dow is down 389 points. That's after a little bit of a move to the upside yesterday. I'll just show you the intraday price action. We started out basically at yesterday's close, and we have just kind of trended down, drifted down ever so slightly, and we are making new lows on the day right now, but not even down 1%. And then contrast to that, we have the Nasdaq, which is up 0.4%. You're going to see a lot of green when I go to the Nasdaq 100 heat map in a minute here. But first, I want to show you the Russell 2000 as well. It was leading yesterday, up 0.5%. Now it is leading to the downside, down 1 1/3%. And we got to check out the bond market because we've seen a lot of action today with the 10-year T-note yield and the 30-year climbing higher towards some of these critical numbers. Perfect. You're going to see 4.49% is the 10-year, very close to 4.5%. And then the 30-year, guess what? That is above 5% once again. And I'll just show you a one-year chart. It has been here before and it has always come down, but these dips have become shallower and shallower. So sometimes when the bond market, when yields have been going up, that has spilled over into stocks and they haven't liked that. And that might be what we're seeing today. So let's take a look at the sector action. We have XLK, that's tech sector. That is the only one in the green right now. To the downside, we have materials, healthcare, financials, energy, discretionary, and real estate. All the bottom row down by more than 1%. And here is the Nasdaq, and we're going to talk about Nvidia quite a bit here. That is up 4%, and you're going to see the mega caps doing nicely here, maybe a little bit of a safety trade, and also the semiconductors. Just in general, we're seeing a lot of bumps to the upside here. Taiwan Semi up almost 4%, AMD up 6%. And if we take a look at our leaderboard here, we can see that China's doing very well today. Chip stocks are doing well, the Mag 7, but most of the space is in the red. To the downside, we have cannabis, home builders, and biotech. Those are all down about 2.5% or more.
And a big reversal from the U.S. on AI chip sales to China. That was another big story we're watching closely today. Nvidia receiving government approval to resume sales of its H20 chips to China. Dan, get us up to speed on the nuts and bolts of that deal.
Yeah, Josh, basically what's going on here is, as you said, a complete 180 where Nvidia was originally banned from being able to sell its H20 chips into China. Now the Trump administration is going to be looking at letting them go forward and sell those chips. And so Nvidia released a blog post late last night, saying as much. We also, just throwing it out there, AMD is also able to file for those licenses and hopes to begin selling its chips back into China as well. But look, this is a very big deal. And just to give you a little bit of info on this, in their most recent quarter, they had written down $4.5 billion as a result of that ban. They were saying in the current quarter, they were expecting to take an additional $8 billion charge because of that ban. Now the thinking is, well, maybe they'll be able to get some of that back as they move forward and start to be able to sell back into the Chinese market. So I think there's going to be some questions about lumpiness when it comes to revenue. Okay, are we going to see this big jump right away and then it'll kind of flatten and even out and continue to rise from there? That all kind of remains to be seen. One of the interesting things that Stacy Rognan over at Bernstein had pointed out is that obviously Jensen Huang had spoken about the $50 billion total addressable market there in China, but he had also said that the recorded revenue in the first half of, or in the first quarter was 5.5 billion in China. So now that would imply 14.5 billion in additional revenue in the second half of this year. So that could be a big boon for Nvidia moving forward. And obviously investors very excited about that. And
Dan, just frame it for us as investors. How big is the China opportunity for Nvidia and AMD?
Yeah, obviously it's a big opportunity. Right now, the largest market for Nvidia is North America, right? But China is still a major option and place where they can see huge growth over time. There are a number of labs that are working on AI models or inferencing, things along those lines, that are going to continue to grow, and we'll see major projects move forward, just as we're seeing from the big cloud providers here in the US, which, by the way, are also expanding abroad. So I do think that there's going to be a lot more opportunity in China, and it's one of the reasons why Jensen had been saying for a while, look, if we aren't in China, then China's going to figure out a way to get AI capabilities on its own, whether that's through Huawei chips or something else, and then you're just seeding that entire market. You're going to have this kind of bifurcation in the AI space, where some companies are building on American Nvidia chips, others are building on Chinese Huawei chips. Wouldn't you rather have them be building on the American Nvidia chips? And so that's been his argument the whole way through. And then obviously previously the US government was saying, we just don't want them building on anything at this point. A lot of this happened around DeepSeek obviously coming out, and then the US-China trade negotiations. We'll see if this holds, if things continue to go well with China and US trade negotiations. If not, I mean, maybe this kind of falls apart, but we'll just have to see moving forward now.
Now, Jared, knowing what's behind the deal with Nvidia, as Dan just laid out there, what does it all mean for the stock, for the company?
Well, I think with the stock at record highs here, and let's just take a look at the intraday price action. The big question for investors is, should I buy a record high? Because you have fear of missing out, or you have fear of jumping in potentially. This is the intraday. Let me just show you the year to date, and you can see it's been a lot of sideways action here. So we haven't had a big breakout in a while, and 170 is definitely a record high if that holds into the close. And I want to show you a longer term chart that I've prepared here. This goes back to the inception, basically 1999, beginning of the century, and I wanted to show you that the length of time between these record highs, so you have a lot of valleys in here, that has been getting shorter. So we had 58 months, that's basically 5-6 years. Then we had 103, that's basically 8 years. But as price has risen, and this is log scale, and I'm kind of tracing out the price action here, we're seeing the zigs and the zags get a little bit less. Now, some of those are still big. You're seeing losses of 58, 43, 69, 43%, but they are shorter in duration. But then I have a second chart, and this kind of helps answer the question that I originally posed. Should investors be buying these record highs? Well, that has been a dangerous proposition at various times. So this goes back to 2019, basically just before the pandemic. And I have here, it's hard to see, but I'm circling all the instances when Nvidia broke to a new high after having a 10% retracement or more, and there have been a lot of fake outs. And so that's a potential that investors face right now, especially within recent memory. The last few years, there were a couple fake outs right here in 2024. We had one at the beginning of the year as well. So you put it all together, it could be a dangerous proposition if you are just trying to make a quick pop buying those all-time highs. If you're a longer-term investor and you're dollar cost averaging, that is a totally separate story. Back to you.
And Callie, I want to get you in here as well. When you saw those Nvidia and AMD headlines drop, Callie, I'm just curious, were there, in your opinion, broader lessons learned from all this for investors in terms of the tech and AI trades?
Well, one thing that I noticed, and obviously this is good news for Nvidia itself, but one thing that I noticed in today's market action that Jared actually pointed out is that a lot of tech stocks rose on the back of this, especially the Mag 7 names that we're all used to, the Apples and the Microsofts of the world. This seems to be a broader sign that maybe trade tensions are easing back, especially with China, and there might be room for negotiation there. Of course, these headlines change from day to day, so I think my broadest takeaway is that, this is a headline that's good for Nvidia, but not to extrapolate too far out there. Expectations in the tech sector are still quite high, and I think you have to be careful, especially with stocks that are running more on hype than actual profit growth like Nvidia is.
Are you in that camp, Callie, that tech is overvalued here? We have smart strategists come on the show. They make that point.
I think so. I think it's a complex statement to make because there are plenty of different flavors of tech. And Nvidia, if you look 2 years ago, the PE ratio or where it was trading relative to its profits was actually quite higher than it is today. So it's something to consider. I think you have to be picky in the tech sector. We're certainly not fans of black and white investing over at Ritholtz. We're not talking about selling away versus going all in. I think with tech, obviously the AI story is compelling, but right now it's an important time to maybe rebalance out of those tech gains just because the sector has done so well.
Let's keep talking about all things AI, because President Trump attending a major AI and energy summit today in Pittsburgh. It is the inaugural Pennsylvania Energy and Innovation Summit, organized and hosted by Republican U.S. Senator Dave McCormick. Leaders from the largest energy and tech companies are there too. Senator McCormick is announcing billions of dollars will be invested into energy and innovation in that state, including the construction of data centers to help provide the power needed for AI endeavors. The $90 billion investment is expected to create jobs and put Pennsylvania on the map as a hub for artificial intelligence and tech, according to McCormick's office. And stick with us, we're just getting started here on Market Domination. Coming up, inflation on the rise, and it may be just the beginning. We're bringing you an expert take on recent CPI data and more. Plus, the short list for Fed Chair Powell's successor may be getting shorter. We may soon learn more about who's being considered for that spot. And on the trade front, President Trump says he's reaching an agreement with Indonesia. We're going to have that story and more on trade talks coming up. Inflation ticking higher in June, the consumer price index rising 2.7% on an annual basis, an increase from May's 2.4% gain. The latest inflation data is showing signs that tariffs may be starting to make their way through the system. For more on the latest inflation signals, let's bring in here KPMG U.S. Chief Economist. That would be Diane Swank. Diane, great to see you. So investors, of course, Diane, very eager to learn if and how much tariffs are impacting inflation. What did we learn today, Diane?
Well, what we really saw was many of the goods prices started to pick up. We also saw inflation in grocery bill prices. Coffee is up at a double-digit rate from a year ago. That's an eye-opener. But we saw everything from appliances, furniture, sporting equipment, and tools, which are heavily imported or contain a high input cost from tariffed goods. And those things are starting to show up as increases in prices. There's also some spillover effect into the service sector, which a preliminary study by the Federal Reserve revealed as well, that you get sort of contagion effects even in areas that are not affected by the actual tariffs, and that's what's worrisome to the Fed. So what we'll see is more of this in the month of July. New vehicle and used vehicle prices did not go up during the month, but we know that a lot of the price hikes that were announced were at the very end of June, and that will show up in July. And on used vehicles, we saw a big pop in used vehicle prices in the most recent Manheim. That's the auctions that they do for used vehicles, and those lead by about a month in terms of used vehicle prices. So people are turning to used vehicles because new car prices are going to be higher due to tariffs, and that's buoying those used vehicle prices as well, and that will show up in July.
Diane, you mentioned the services sector, and I saw some of your colleagues, some of these very esteemed economists, they were telling their clients, Diane, I want your take on this, they sort of made a beeline for that services sector and calling out, they said, the disinflation there, and they were calling out airline fares, Diane, and auto insurance premiums and shelter costs cooling, they said, and basically arguing to their clients, hey, this is a reason not to be so concerned about that tariff inflation boogeyman. So what do you say to that?
I absolutely agree that airfares were down, hotel room rates were down, and we're starting to see the cooling of shelter costs. I mean, they're still extremely high price levels, but the pace of increase on shelter costs has gone down, and in part helped by some of these service sector areas. But in some of the other areas, especially when it comes to things like the care economy in service sector, that's a little bit of a different equation. So the problem is, what we had was disinflation or deflation in goods prices for decades. And much of the reason you're not seeing it show up in things like apparel prices yet is because almost everything that's in stores was actually ordered prior to the tariffs. And once those inventories are depleted, you will see those prices show up as well. So yes, there is some good news as well from the Fed's perspective, but on net, inflation still picked up. And at the end of the day, that's important. And the reality is that whether or not it comes across the board doesn't really matter. When it starts to hit goods and groceries, that matters to most households. And
so we have the Diane Swank take. What do you think, Diane, the Fed made of that report?
So from the Federal Reserve's perspective, they're still in wait and see mode. And the report showed the signs of tariffs. That's something they're going to be watching closely. With a 4.1% unemployment rate, although I think the margin of error is very narrow in the labor market right now, they still hold off for the month of July, and we do not have the first rate cut until December. Now, that really depends on how much inflation we see and how much weakness there is in response to that inflation, or the margin squeeze that many producers are now feeling due to both persistently high rates and higher tariffs and input costs. So depending on how much, that's why it has a sort of stagflationary risk to it. But we expect the Fed to not start cutting until December, which is not as soon as many would like.
No, and that would include the president, I think, Diane, we can safely say. So we had CPI report. We also have retail sales coming out, Diane, which is always a look into the consumer. How would you characterize the consumer broadly here, Diane? How healthy, how resilient?
Well, the consumer is continuing to spend, but at a much slower pace than it had been in 2024. And we know that much of spending was concentrated in the top 10% of households, account for almost half of all consumer spending. What's a little worrisome going on now, consumer is still spending, although I expect the retail sales to be lackluster at best. But one of the things that we're worried about is that concentration of high-income consumers accounting for so much, one, that's not good for the economy. Overall, it means less consumer spending rather than more consumer spending, because there's a fewer group of people that tend to save more. But it also means, and I think this is really important, we're starting to see the biggest increase in delinquencies among the most affluent zip codes. That's after we saw stress begin in lower and middle income households, and you saw that in things like fast food chains not doing as well, and the idea that consumers are pushing back against some of the price increases because their budgets are strained. So we're a little concerned about consumer maybe missing a beat. We think we're going to avoid a recession, but the third quarter, as we get into these summer months and the back to school season, when you start to see tariffs really bite, that could be a much more dicey situation for the U.S. consumer.
One more headline I want your take on, Diane. This was Treasury Secretary Bessent suggesting Jay Powell should step down from the board when his term is up next May. And Bessent telling Bloomberg there's a formal process that's already starting with regard to identifying the nominee to become the next Fed chair. Went on to say there are a lot of good candidates inside and outside the Federal Reserve. I'm just curious, Diane, this political pressure on the Fed, which really does seem to be increasing here. How, if at all, Diane, does that impact your job as an economist? Does it affect, Diane, your forecast? Does it affect how you think about risks to your forecasts?
Well, it certainly affects risks to the forecast. After Jay Powell's term is over, he does have a board position which he could stay on in, which a couple of Fed chairs have actually done, stayed on after their chair to finish up his board service through January of 2028. That is a choice he has, and it's his choice to make. And that's not something, of course, the administration would like, because they actually want to have that extra seat on the board. And much of it will depend on how much there is a threat to the Fed's actual independence. Is there going to be an actual, a bending to political will within the Federal Reserve? That always backfires. We know that it happened in the 1970s, and it's part of what seeded and stoked the stagflation when OPEC prices exploded in the 1970s, was actual interference by the Nixon administration. And it's really seared into the institutional memory of the Fed, of the mistakes of that era, and every central bank out there, of the mistakes of that era and what causes stagflation. We've seen the most extreme of this in Turkey, where they basically, had their central bank stimulate, and they had a major depreciation and a huge surge in inflation, and it was really very counterproductive, and rates ended up going up and wiping out all the gains that you get from the stimulus. So no matter what they do, the complexity for us as economists is to watch if there is real, tangible threat to the Fed's independence, or even a perceived threat, that can actually put upward pressure instead of downward pressure on Treasury bond yields. And that's not the direction that the administration wants to go in.
Diane, so good to have you on the show today. Thanks so much for your time. Appreciate it.
Thank you.
Callie, I want to get your thoughts on what I actually just asked Diane Swank about, which was Besson, these comments, Callie, that he made to Bloomberg that Jay Powell should step down from the board when his term is up next May as an investor, a strategist. How do you think about that?
Well, I definitely agree with what Diane said. It's not customary for the Fed chair to stay on in a governor position. You see that all the way back to at least Arthur Burns in the early 1980s. But it is it's Chair Powell's choice, and the Fed is in a really tough spot right now. I think we can all agree that Powell understands the threat to independence. It's a risk that you have to consider, especially when, as a portfolio manager, you're looking at how to hedge your portfolio and knowing that the risk, as Diane mentioned, does sit in the longer end of the curve. And look, if you're hedging against economic weakness or a stock sell-off, you're not going to get that out of the longer end of the curve if it's influenced by Fed independence and government deficits and these external risks that you have to think about. So I definitely think it's a risk. I think it's a low risk given what we've seen. But I think it weighs large on investors' minds, and some people might be setting up their portfolios for the chance of a Fed independence crack.
Do you think, Callie, we were talking about this off camera, do you think investors are looking through Powell at all, over Powell, already looking to, okay, the post-Powell world, Trump's going to have his pick, that pick will largely, you would assume, be in line with his perspective. What do you think about that?
I think it's starting to happen. I wouldn't put too much weight on it. It's certainly a smaller scenario than some would make it out to be. But with all the rhetoric going around, especially the market reactions we saw to Trump suggesting that he may fire Powell a few months ago, yeah, I definitely think investors are taking that into consideration. And what that can do is potentially make them lean on that rate cut scenario a little too much, especially heading into next year. I mean, the Fed's hands are tied. I agree with Diane on that, especially after today's report. If you're Jay Powell, I mean, this is the report that you feared, but in a way you expected it because the Fed expected to see some impact from tariffs throughout the summer.
And Jared, Callie bringing up that CPI report. Walk us through how, Jared, the market's responding and reacting to that.
Sure. Let's talk about what happened today. I'm going to put the S&P 500 futures on because they were open at 8:30 a.m. Eastern when we had this report, and I'll just circle it right here. We had a brief spike to new highs, and then on the open, we pretty much drifted into the red here, and we've been in the red most of the day. And I want to show you what happened in the bond market because that's a little bit of a different picture. I'm going to focus on the 30-year. Usually I talk about the 10-year, but the 30-year is now above 5% at 5.02%. And you can see, and this is an hour behind us in Central Time, we got a little bit of a dip here, and then we rose, and right around the time of the open, we were heading into that 5% territory in the 30-year. Anytime that's happened in the past, I've noticed that stocks tend to roll over, and so that's something that we saw happen. There was a little bit of pressure on the open here. Nasdaq is a different story. I was talking about the S&P 500 before. Nasdaq in the green today, thanks to some of those mega cap stocks. But I want to show you a longer term look of what I'm talking about here. This chart right here shows the S&P 500 in white going back to October of 2022. Why October of 2022? Because that's when the bull market began. And in green here, I have the CPI reaction in the S&P 500. So in the beginning, we had a bunch of reports that were better than feared, not as bad as feared, and we saw big reactions to the upside in the S&P 500. And as it turns out, we have had about 15 percentage points thanks to these CPI days that are being reflected in the S&P 500's total gains over this bull market period. A little bit off of the highs here, but now I want to show you a different picture. And this is the 30-year Treasury yield. And in white, this is what the 30-year has been doing. You can see it's pretty choppy there, but it has been touching either above or just below or exactly at that 5% mark several times here. And that's where we are right now. And that's a critical level. And I think it's instructive that we are seeing a 5 basis point move to the upside in the 30-year. So the net result of all of this is not a great net reaction because basically the 30-year has gone nowhere on these 30-year yield. The 30-year has gone nowhere on the CPI days, but it has been trending up since last October, and today is just kind of that final bucket in there. So you put it all together, these reports do matter, and CPI has been the biggest contributor to the S&P 500 gains, and now it is pushing the 30-year to the upside above that critical 5% level, and guess what? We're seeing stocks, for the most part, roll over.
All right, thank you, Jared. Up next, Team Trump has been saying the market understands what they're doing on tariffs, but observers may have other thoughts. We have that story coming up. Stay with us. Big banks reporting quarterly earnings on Tuesday, including JP Morgan, Wells Fargo, and Citi. For more, we're bringing in Chris Whalen, Whalen Global Advisors Chairman. Chris, great to see you, especially on set.
Yes.
Let's go right into some names. I'm going to start with what is not working today. Wells Fargo is down about 6% in today's trade, getting hit, lowered net interest income guidance here. That appears to have surprised some folks. Chris, what do you make of the print and the reaction?
I think the reaction's overdone. This is a very different bank than it was when the Fed put the cap on assets. The numbers were okay, nothing spectacular, but the whole industry is like that. Jamie Dimon is barely growing. He actually was down slightly on revenues. Same with Citi. Citi is growing corporate loans. That's about it. Consumers not doing anything.
So you on Wells, you think this is
buying opportunity?
It is. It's an overreaction.
Yes.
Let me ask you this, because in terms of what's ahead for this bank, you mentioned this last month released from the Federal Reserve asset cap. CEO Charlie Scharf saying, we now have the opportunity to grow in ways we could not. He says, able to move forward more aggressively to serve consumers and businesses and communities. What do you make of those comments?
He is going to grow a bank that's not going to look like the old Wells Fargo. Remember, the old Wells Fargo had a third of the residential mortgage business at one point in 2008, and even after. They saved the residential market for a decade after the crisis. Now they're going to look more like a traditional community bank. Corporate lending, consumer lending, a few other things, but they're going to make loans inside their footprint with their branches, with their people. They're not buying third-party production from other firms anymore. So it's a very different story, and it's less risky. So to me, if you like a JP Morgan, if you like some of the other big banks, but you think they're too expensive, go look at Wells. Same thing with US Bank. US Bank is still digging out from a huge acquisition in California. They're going to be penalized for that.
You mentioned JP Morgan. Let's touch on that report too. One thread to highlight there. Investment banking, Chris, fees rose 7%. Street was expecting a decline. What happened there?
They work harder than everybody else. Jamie drives them like, a demon from hell. And they also remember, look, the CFO of a large bank has a lot of leeway as to when they recognize revenue, putting GAAP aside for a minute, okay? So Jamie always meets and beats his estimates. He's got that flexibility. But I also think, the franchise that they have, the way they finance it, the different components they have is really hard to beat. They have 10 points of operating efficiency on everybody else. How do you compete with that?
Well, let me ask you, looking at the stock reaction, it's down about 0.5%.
Right.
Is that explained, Chris, by just the run into the print? Is that a valuation concern?
It's a run into the print.
Okay, that's what you make of it.
Yeah. All of my group took a dive after Trump announced the first tariffs. They've since come back and then some. So most of the large banks that we track, we publish an index on the top 100, have more than come back from the highs last year. And then obviously they bottomed out. There was a huge buying opportunity. So now, are they fair value? Yeah, because there's no growth. If you look at deposit growth, if you look at loan growth, it's not terribly exciting. Single digits. I was impressed that Citi was putting on a lot of corporate loans.
I want to talk about Citi because let's get to a name that's actually working in today's trade. That's popping. What do you make of those results? They did lift expectations. I'm just looking here. Full year revenue, Chris, now will be about $84 billion, and that looks to be the top end of the range they gave there.
That's right, and I think a big hat tip has to be given to Jane Fraser.
What grade do you give Jane?
She's a B+ now.
Yeah, I feel like you're a hard grader, by the way.
Oh, I am, because I was giving her a real hard time on operating expenses.
Yeah.
She still has work to do there because the whole model is expensive. When you had retail and institutional all over the world, by definition, you weren't going to be competitive on expenses. Now she has to try and focus on an institutional business. They're going to be very careful what they do in the US. They're not chasing consumers in the US. They're going to introduce a new card. Who is that for? That's for the private banking clients, right? So they're going up market. They want to deal with a more affluent customer that looks like Jamie Dimon's customer, by the way. And that's her model. She still has to cut 5 points out of her operating expenses, though.
When you look at the reports today, of course, we've gotten so far, we have some big ones on deck. Broader lessons to you learned from these reports about the economy, about the consumer?
We don't have a consumer recession yet. A couple banks were actually dropping their credit expenses and their bills.
Does that surprise you?
No, because it's been this way now for 3 quarters. What I was happy seeing is that some of the banks are actually seeing some lift in revenue, and they're also start to see more expensive funding. We've had funding and loan yields dropping for 3 quarters. That's deflation, boys. We don't want to see that. And it tells you there's a lot of slack in the economy. Banks are fighting for loans. And that means they've got to drop their loan rate. It also means that they don't need all of those deposits that they needed last year. So they're going to let them go. They're going to drop their deposit rates. So we still have an economy, to me, that is slack. That's how I would put it. That's the best summary I could give you.
They're telling me I have to wrap, but I need the Chris Whalen take on what's on deck. Goldman, Morgan Stanley, what do you expect?
I think both Goldman and Morgan Stanley are going to deliver the goods on the market side. Both have been building AUM. Morgan Stanley is really a good bit ahead of Goldman. Goldman has to fight for every dollar of market share they get. They don't have that same base that Morgan Stanley has. But buying Smith Barney from Citi, it hurt Citi a lot, and it helped Morgan Stanley tremendously.
The IPO market showing signs of life, though. Isn't that good for David Solomon?
It should be. It should be. But the quality of the IPOs is kind of suspect. Crypto companies, I'm sorry. I'm still not a big fan of crypto. I don't mind. You want to make money on crypto, do it. But I'm much more of a long-term advocate for gold. Gold is going to return to be the chief reserve asset of the world.
We're going to have you back on the show because I want your thoughts on that, too. Thank you, Chris. That was great.
My pleasure.
Appreciate it. Markets growing less responsive to ongoing trade talks, and there's differing views on why that may be. For more, let's get to Yahoo Finance's Washington correspondent. That would be, of course, Ben Worschel. Ben.
Hey, Josh. Yeah, so this is the question, kind of one of the big questions of the month for markets is sort of why are markets shrugging off these tariff threats that I'm on with you pretty much every day to outline. It come kind of every day from Trump. It's a nuanced question for sure. Our colleague Josh Schaefer has a smart look at the kind of China aspect of this. But what I'm looking at for a story tomorrow in Yahoo Finance is the White House view of this. And this is important for traders to know because it's essentially 180 degrees away from most of what you're going to hear on Wall Street. The White House case, which we've seen in evidence in recent days, and it's gotten sharper kind of as markets continue to rise, is essentially that the signal we're getting here is that traders are okay with tariffs now. The traders are saying that they understand what Trump is trying to do with tariffs. And that the market reaction is reflecting that. You see a lot of skepticism from that on Wall Street, who kind of give the opposite view that traders, it's not like traders like tariffs now, they just don't believe Trump is going to follow through. But we're seeing this again and again. Treasury Secretary Scott Bessent offered this morning that the markets understand what Trump is doing now, which is a clear contrast to April. Somebody's going to be wrong here. These are two sides, and the question is kind of whether this question gets tested. The way it doesn't get tested is if Trump can follow through on different trade deals and lower rates via that route for him. We saw one pact with Indonesia today, but it does get tested if some of these trade deals don't go through, and then Trump is essentially empowered by this view that by the markets not rising so far, maybe he can stand firm on tariffs and go forward. Put another way, does the market looking at the taco trade essentially lessen the chance of Trump chickening now? We're seeing some concerns on that front that maybe the markets are underpricing. You were talking about Jamie Dimon earlier. He's offered commentary on this. The markets are complacent in this. This is going to be a big theme of the next few weeks as we get to this August 1st deadline.
And Ben, just quickly, you mentioned Indonesia there. I want your take, because Trump did say he reached this deal with Indonesia. It does sound like we have some specifics there. Ben, What are the details?
Yeah, so we have some specifics from the White House side on what this Indonesia pact brings forward today. Trump sketched it out to reporters and also in a Truth Social post. The headline here is a 19% tariff on Indonesian goods, and according to Trump, a 0% tariff on U.S. companies trying to do business. As Trump put it, quote, full access to Indonesia. He added in Truth Social that there's other aspects here, $15 billion in Indonesian purchases of U.S. energy, $4.5 billion in American agriculture, and 50 Boeing jets. The key caveat here is that we do not have confirmation on this from the Indonesian side. This is a trend we've seen where Trump will announce a deal, and then the question is whether the other side has agreed to all the terms here. We saw a little bit of that with Vietnam. But either way, this is a clear indication that this is the sort of model. Trump even had a comment about this today, that this is the sort of outline of what he wants with these other deals. Essentially, somewhere around a 20% tariff on product coming in, and then a 0% tariff on products going out. It's the sort of same parameters of what he laid out with Vietnam. So it comes as sort of Trump is promising other trade deals, again ahead of this August 1st deadline. In his view, hoping to be kind of this be the model going forward.
All right, Ben. Thank you, sir. Appreciate it. More market domination right on the other side. Now time for some of today's trending tickers. Taking a look at China stocks, those getting a lift amid potential of Nvidia's return to China and resilience in China's economy. So this one, different news on China today we were talking about. Nvidia and AMD, of course, plan to resume some chip sales in China there. Then Barron's with a good piece, just kind of talking about China's economy slowed less than feared in the second quarter. They do cite Goldman Sachs as saying no broad-based significant stimulus in the near term. But we saw some moves in names today. Alibaba, JD, Baidu. What do you make of it?
Well, kind of going back to what I said earlier in the show, I think this is just this umbrella of assumption that U.S.-China trade tensions might cool down with Nvidia's announcement today. I wouldn't be so sure. I watch the headlines just as you do. They go back and forth, but I think it was a bit of a rising tide lifts all boats situation, and then tomorrow we might see some differentiation as investors take a step back and realize what the announcement actually means.
To your point, we have a trade truce. We have kind of a trade handshake with China. We don't have a trade deal yet. To your point, maybe don't get ahead of ourselves. Is that your takeaway there?
I think so, and I think with China, we forget that we still have a 30% or even 55% tariffs in some cases with one of our top trading partners. That's not easy to swallow, and we're starting to see that impact show up in goods that come out of China, especially in today's CPI report. We saw it in household furnishings, we saw it in auto parts. So our trade relations with China aren't spectacular, and you're right, we haven't seen a final trade deal. And I know from experience, from sitting through the 2018-2019 trade war, that this stuff doesn't end easily. Is it 150% like we heard right after Liberation Day? No. Is it ideal? Definitely not. All
right, moving on. Here's another one to look at. That would be BlackRock, as its assets under management did hit a new high in the second quarter. So this one was interesting, Callie. So revenue, it looks like, in performance fees, miss estimates. They did, as we know, they hit a record, looks like $12.5 billion in assets. The stock, though, was under some pressure. They did take in, it looks like, $94 million of performance fees. Estimate was $114 million per Bloomberg. We should note shares had rallied to a record into Monday's close ahead of that print. What do you make of that one?
I want to know how much of that came from IBIT. IBIT, one of their most popular products, the Bitcoin ETF right now. I mean, BlackRock, like many other ETF providers, is in the low-cost space, and that's just where the ETF industry is going. So am I shocked by the fact that they're not able to, have much leverage on their fees? No, they probably know that. That's why they're expanding into new markets like IBIT, like private funds, like alternatives.
Most on the street still argue this one is a buy, which is interesting. Finally, last one, let's look at DoorDash here, because shares also under pressure, gets hit with a downgrade at Jefferies, lowering its rating on that stock from buy to hold. So Jefferies goes to the sidelines. Looks like their target is 250. They target to their clients, Callie, about they do talk about the company's strong execution, the growth algorithm appear, they say, fully reflected in the valuation now. This stock has enjoyed a run. It looks like it's up around 40% this year.
I thought this view was amusing. I read the Jefferies note as well. The reason why I do is because I'm an avid DoorDash user, and I'm the one.
As are the Liptons, very much.
Yeah, and I think a lot of people are, but I'm also the first person to get excited when I see like a 10% off coupon. And the reason why Jefferies downgraded DoorDash is because of these affordability initiatives, which is what they called them, but they're really, what they mean is coupons. So pay full price for DoorDash, it'll help the stock, at least Jefferies thinks so. But overall, it's not the easiest spot to be in, being a smaller tech company and having to punch against the larger players.
Again, most on the street still like this one, but Jefferies, steps to the sidelines. We are wrapping up today's market domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.